So you're thinking about making the switch to an electric vehicle. That's awesome. But you might be in for a different kind of shock, and I'm not talking about the battery. We're going to dive into the crazy high cost of EV insurance and figure out exactly why those quotes can feel so, well, random. Imagine this number just lands in your inbox, $420 a month. You'd think they made a typo, right? I mean, it's the same driver, same boring commute, but suddenly your insurance bill feels like you're renting a small apartment for your car. This is a real gut punch for a lot of would-be EV owners.
So, what is going on here? Why does it feel like insurance companies are just throwing darts at a board behind the scenes? You know your driving record is clean, you're not out there drag racing your new EV, but the quote is just astronomical. Well, you're not going crazy. You just haven't been let in on how the game is really played.
Okay, let's get right into it. We are going to unpack that absolutely staggering number and pull back the curtain on the truth behind all that sticker shock.
You know, a high quote like that can feel kind of personal. But here's the thing, it isn't. Insurers don't see you as a good or bad person. They just see a profile. It's all a cold, hard math problem based on what they call risk signals. And once you understand those signals, you can actually start to change the story.
In that math story, well, it's pretty much all built on three main factors. Three quiet, hidden levers that insurers are pulling behind the scenes to land on your final price.
And here they are. Okay, look at this. The single biggest lever, the one that makes the most difference by a long shot, is your credit score. Yeah, you heard that right, your financial history. After that, it's your zip code, basically the risks tied to where you park your car every night. And then finally, you've got your daily commute and how many miles you drive. So if your quote is painful, you want to start by looking at that biggest bar on the chart.
So let's really break down how each one of these three levers is quietly working to rewire your final premium.
First up, the big one. The one most people don't even realize is a thing. The credit-based insurance score. Now, this is not the same as the FICO score you'd use for a mortgage. Insurers have their own secret sauce, a score that uses parts of your credit history to guess how likely you are to file a claim. Their data, for whatever reason, shows a link between how people handle their money and how they manage risk on the road. It's not about your daily coffee habit, it's just a proxy for responsibility that, for better or worse, is a huge piece of their math puzzle.
And the impact on your wallet? Whoa, it is massive. Just look at this table. For the very same driver in the exact same EV, just going from a poor credit rating to an excellent one could be a difference of over $200 every single month. That is a gigantic swing.
Look, we're not talking about saving a few bucks here. Improving your credit score from one tier to the next isn't just about getting a better rate on a loan. It can literally pay you back, month after month, with a lower insurance premium. It's a huge, recurring financial win. All right, lever number 2, your zip code. It might just be the most expensive 5 digits in your life. Here we're looking at two drivers, identical profiles. The only difference? One lives in a quiet suburb and the other lives in a busy downtown area. That move of just a few miles can make the premium jump by 20, even 40%. Why? Just because you're now in what they consider a higher risk pool for things like theft or vandalism or even just fender benders. And a quote from the source material really just nails this point. Lock the year and zip before comparing rates. A 5-digit change can matter more than your last 3 driving years. Let that sink in for a second. Where you live can literally matter more to an insurer than how you've actually driven for the past 3 years. It's wild.
And the final lever, it's your daily commute. Insurers care a lot about how much time you're actually spending on the road. As you can see here, a 30-mile commute compared to a little 5-mile one can easily tack on an extra 10 to 25% to your premium. But here's the good news. If you've recently switched to a hybrid schedule or you're working from home now, accurately updating this number is probably one of the fastest and easiest ways to save some real money.
Okay, so we get the problem now, and we know about the levers they're pulling. That's great, but what can you actually do about it right now? Let's get into a clear, actionable game plan that you can use, like today.
First up, let's do a quick self-assessment. Run through this checklist in your head. Are you in at least the good credit tier? Got a clean driving record? Short commute? If you can honestly say yes to 3 or more of these, then hey, you are in a fantastic position to find a much better quote than you might think.
And here it is, your game plan, a simple, step-by-step process. First, just get a clear snapshot of where you stand right now. Then, run a quick estimate online to see if you're overpaying. Next,
And this is key. Pick just one lever to focus on improving. And finally, when you shop around, please compare the actual coverage you're getting, not just the bottom line price tag.
And just remember, you don't have to completely uproot your life to see a real change here. A lot of the time, you can lower a high quote just by describing your life more accurately. If you went from commuting 5 days a week to maybe 1 or 2, that is a real reduction in your risk profile, and your insurer absolutely needs to know about it.
So let's bring this all home. The goal is to turn that initial sticker shock into a much smarter plan. That number in your inbox, it wasn't a final verdict. As the source material puts it so well, it's just a badly explained math problem, one that you now have the tools to actually solve.
And that leaves us with one last question. And this one's for you. Looking at these 3 levers, your credit, your location, and your commute, what is the one thing you can realistically do in the next 90 days to start changing your own EV insurance story for the better?